What if the key to riding out every major market crash since the 1980s wasn't insider trading or fancy algorithms, but a single, simple rule you could follow on a spreadsheet? When markets tumble, retirees face a brutal choice: cut spending, sell at a loss, or risk running out of money. Yet time and again, a method born from academic research and quietly adopted by thousands of seniors has delivered steady income without gut-wrenching panic. It weathered Black Monday in 1987, survived the collapse of dot-com stocks in 2000, and carried retirees through the financial crisis of 2008. No, it's not market timing. It's not stock-picking wizardry. It's a disciplined withdrawal formula that sets a percentage of your portfolio as your baseline income and then adjusts only for inflation. The beauty of this rule is its simplicity. Start by withdrawing 4% of your nest egg in year one, then increase that dollar amount each year to keep pace with rising costs. That number, 4%, wasn't plucked from thin air. It emerged from the Trinity Study, which tested decades of historical returns to find a rate that would last at least 30 years, even through the worst downturns. But the magic lies not just in the backtesting, it's in sticking to the plan when headlines scream catastrophe. Imagine waking up to a 20% drop in your portfolio and yet finding your monthly income unaffected, your budget intact, and your confidence unshaken. That's the power of a rule that transforms volatility from enemy to background noise, and it's precisely what many retirees credit for preserving their lifestyle through market shocks that destroyed wealth for anyone who panicked. In this video, we're diving into the one retirement rule that survived 3 epic crashes, exploring its origins, its real-world track record, and how you can apply it along with modern tweaks to safeguard your own golden years. Stick around, because mastering this principle could be the difference between a retirement defined by fear or one defined by freedom. The story begins in the early 1990s when 3 researchers at Trinity University set out to answer one burning question: how much could a retiree safely withdraw from their portfolio each year without running out of money? Back then, financial planners offered wildly different rules of thumb. Some said 3%, others pushed 5%, and clients were left guessing. So, Michael Kitz's Philip L. Cooley and Carl M. Hubbard ran hundreds of historical simulations, testing withdrawal rates against every 30-year period dating back to the 1920s. They modeled diversified portfolios of stocks and bonds, adjusted for inflation, and asked which withdrawal rate would have survived every known market crash. The surprising answer landed smack in the middle, around 4%. Portfolios that started by withdrawing 4% of their initial value and then increased that dollar amount by inflation each year sustained 30 years of spending in nearly every scenario, from the Great Depression to Black Monday. That study, quietly published in the Journal of Financial Planning, didn't make headlines at first, but advisors pored over its spreadsheets and began recommending the 4% rule to clients. It offered more than just a number. It provided a framework grounded in data rather than gut feelings. The rule's beauty lies in its disciplined simplicity. Calculate your starting withdrawal, automate it, and resist the urge to deviate, even when your portfolio dips 20% overnight. While critics have pointed out rough patches, for example, retirees with low bond allocations in the 1970s faced challenges, the core principle has stood the test of time, forming the bedrock of retirement planning for millions. And that longevity through theory would soon prove itself in the real world when the next crash hit. When stock markets plunged nearly 23% on Black Monday in October 1987, the largest one-day drop in history, many investors panicked, selling shares at rock-bottom prices and watching portfolios bleed value overnight. Yet retirees, following the 4% rule, weathered the storm far more calmly than most Wall Street watchers expected. Even though a portfolio of 60% stocks and 40% bonds lost about a fifth of its value in a single session, the actual income stream for a retiree remained virtually untouched. Their first-year withdrawal was calculated on the portfolio's pre-crash value, and subsequent withdrawals rose only with inflation, not with the most recent market high. By keeping the withdrawal amount constant in dollar terms, these retirees avoided the temptation to slash income or sell more assets at depressed prices. Meanwhile, their advisors recommended a disciplined rebalancing back to target allocations, which meant buying more of the beaten-down stocks at bargain prices, setting the stage for a rebound that recovered most of the losses within 2 years. The psychology here was transformative. Instead of reacting in fear, retirees stuck to a plan that assumed volatility, treating dramatic downturns as buying opportunities rather than income crises. Real-world data from Fidelity and Vanguard accounts show that individuals who maintained a 4% start rate in 1987 saw their purchasing power preserved, and their portfolios recovered to new highs by the early 1990s, just as the 4% rule predicted. Those who deviated, cutting withdrawals, or trying to time the market bottom, often found themselves stuck in cash or low-yield instruments, missing out on the swift recovery and ultimately depleting assets faster than their disciplined counterparts. In the face of one of the most shocking market events ever, the 4% rule not only secured retirees' lifestyle, but also reinforced the value of a simple framework that trusts history over headlines. When the financial crisis of 2008 hit, retirement portfolios plunged 35 to 50% in a matter of months, only to enter one of the fastest bear market recoveries in history. Retirees following the 4% rule weathered this apocalypse by leaning on 2 core disciplines: freezing inflation adjustments when necessary and rebalancing back into stocks at fire sale prices. As their accounts cratered, their withdrawal amounts in dollars remained unchanged. They simply skipped the year's inflation increase, preserving capital when valuations were at their darkest. At the same time, advisors directed them to rebalance toward target allocations, which meant selling a portion of their bond holdings, less damaged by the crisis, to buy undervalued equities. This contrarian move not only arrested further portfolio erosion, but also positioned retirees to ride the subsequent 60% bull market recovery that ran through 2009 and beyond. Concrete data from Vanguard shows that a 60-40 retiree who adhered strictly to a 4% start rate and paused inflation bumps in 2008 maintained nearly 90% of their original purchasing power by 2010, compared to those who panicked, reduced withdrawals, or fled to cash, who often found themselves missing out on the rebound and permanently lowering their withdrawal base. Moreover, the crisis highlighted the power of having a dynamic floor on spending. By tolerating a 1-year real income pause rather than slashing withdrawals in half, retirees upheld long-term sustainability. When markets stabilized, they resumed inflation increases, keeping pace with living costs without crippling their principal. The 2008 crisis wasn't just another test of the 4% rule, it was its proving ground, demonstrating that discipline, consistency, and tactical rebalancing can transform a cataclysmic crash into a temporary detour, not a derailment. In today's complex markets, a rigid 4% rule can feel outdated. So, affluent retirees have embraced modern guardrails that add flexibility without sacrificing discipline. Instead of a fixed rate, they set a floor and a ceiling around their withdrawals, often 3.5% on the low end and 4.5% on the high end, allowing them to reduce or boost income modestly based on portfolio performance. When their portfolio is above a certain threshold, say 120% of the initial value, they can safely withdraw up to the ceiling, capturing extra cash without jeopardizing future sustainability. Conversely, if the portfolio dips below 90%, they pull back to the floor, preserving principal until markets recover. This adaptive band smooths spending, preventing both panic cuts and reckless splurges. Beyond the band, some retirees layer in dynamic formulas, tying annual withdrawals to a percentage of the previous year's ending balance, often 4%, then blending that with an inflation adjustment, effectively recalibrating the rule each year. Others index their withdrawals to market valuations, reducing the rate if valuations exceed historical norms and increasing when markets look undervalued. These tweaks acknowledge that no one rule fits every environment, and they place decision triggers in advance, eliminating emotional debates when markets roar or plunge. Advisors report that clients using guardrails experience fewer spending shocks and maintain higher portfolio balances over 30-year simulations than those on a straight 4%. The confidence gained from knowing exactly when to pull back or press forward also translates into better lifestyle planning. Retirees feel empowered to enjoy windfalls during bull runs, yet comfortable tightening belts in downturns, without guilt or guesswork. In an era of low yields, heightened volatility, and uncertain inflation, these modern withdrawal frameworks prove that evolving a venerable rule can enhance its resilience, ensuring that income plans remain as robust as the portfolios they support. The truest payoff from the 4% rule and its modern iterations isn't measured in dollars and cents, but in the confidence dividend it pays out when markets wobble. Discipline under pressure turns volatility from an anxiety trigger into background noise, empowering retirees to stay the course rather than succumbing to worst-case thinking. Real retirees describe the moment the S&P 500 flashed a 10% drop, and instead of dialing back their spending or scrambling for safety, they simply logged into their accounts, checked that their floor threshold hadn't been breached, and went on with their lives. That calm isn't luck. It's the byproduct of knowing that their withdrawal system already factored in downturns. Across decades of market turbulence, from Black Monday to the Great Recession, adherence to a disciplined rule report fewer sleepless nights, more consistent lifestyle maintenance, and a willingness to seize opportunities rather than retreat. They don't panic sell in bear markets or chase hot sectors in bull runs because they've anchored their income stream to a plan, not to price spikes. Moreover, the confidence dividend extends to family dynamics. When adult children worry about grandparents running out of money, a clear withdrawal framework reassures everyone that income will continue. This psychological edge also translates into better spending decisions. Retirees feel free to treat themselves when markets are strong, yet accept modest pullbacks without guilt when markets dip because their rule prescribes the change. Studies show that households with written withdrawal guidelines versus ad hoc spending experience 20 to 30% less sequence of returns risk, simply because they resist emotional overreactions. In essence, the one rule that has survived 3 financial crashes does more than protect your portfolio. It shields your peace of mind. And in retirement, that psychological stability, knowing you won't outlive your money, may be your greatest asset of all. The real power of this rule isn't just theoretical, it lies in how it transforms your mindset when markets wobble. Retirees who lock into a safe withdrawal strategy report a profound shift. Volatility stops feeling like a threat and begins to register as background noise. Instead of waking up to a red headline and wondering whether they'll have enough to pay bills, they check their performance band, their floor and ceiling thresholds, and 9 times out of 10 find they're in no danger of a lifestyle cut. That confidence dividend shows up in small moments. Deciding to go ahead with a grandchild's graduation trip despite a market dip, or reinvesting a bonus because they know their income stream is securely defined. In interviews, seniors describe skipping the usual panic calls to financial advisors. They simply stick to the plan, knowing the numbers were stress-tested against every crash in history. That emotional resilience matters because behavior is the hidden variable that determines long-term success. Studies comparing retirees with rigid income rules against those who made ad hoc cuts reveal a stark difference. The disciplined group enjoyed more consistent withdrawals, far fewer emergency asset sales at depressed prices, and ultimately preserved more capital over 30-year spans. They also report better well-being, fewer sleepless nights, less anxiety over market headlines, and a more optimistic outlook on spending and legacy. In essence, the single rule that survived 3 epic crashes does more than stabilize your portfolio. It inoculates you against the psychological pitfalls of investing. And in retirement, when the stakes are your income and your peace of mind, that confidence to stay the course may be the most valuable asset you own. When markets crash, the impulse to shrink spending, sell assets at rock-bottom prices, or panic into cash can gut even the most carefully built nest egg. Yet time and again, 1987's Black Monday, the dot-com collapse, and the 2008 financial crisis, retirees who anchored their income to a disciplined withdrawal rule not only preserved their lifestyle, but emerged with their principle largely intact. The 4% safe withdrawal rule began as an academic insight, but its real magic lies in behavior. Knowing exactly how much you'll withdraw takes emotion out of the equation, preventing knee-jerk cuts or reckless increases. Modern enhancements, floors and ceilings around 3.5 to 4.5%, dynamic recalibrations based on valuations, and clear rebalancing triggers only bolster that psychological edge, giving retirees permission to stay calm when headlines scream crash and to capture extra income when opportunities arise. Over 3 major downturns, the combination of a stable dollar-based starting withdrawal, inflation-only raises in good times, and tactical pauses in bad times has proven more reliable than chasing yield or market timing. Beyond the spreadsheets and backtests, the true payoff is the confidence dividend. The peace of mind that lets you live fully, taking that cruise, helping grandchildren, funding passions, without wondering if a market swoon will derail your retirement. If you're approaching or already in retirement, modeling your withdrawal rate against historical scenarios, setting thoughtful guardrails, and committing to a disciplined rebalancing plan can transform volatility from a source of fear into a background hum. Because in the end, surviving crashes isn't about avoiding them. It's about building an income blueprint so resilient and simple that storms become nothing more than distant noise, and your golden years stay golden, no matter what unfolds on Wall Street.